ideas about the market, and you're affixed to numbers, and you're affixed to levels, and you're affixed to something that's very visual, very something that you can see, you can almost touch, and then it's wrong, right? And we don't want to accept that's wrong. That's what you're saying. And what you're saying is more like and we were talking about sports earlier, be more like a hockey player than a baseball player, right? Hockey player adjusts, adapts, and it's a flow sport. Trading is a flow job, whereas baseball is more calculated, more logical, I would say, more planning involved. And there's reaction too, but not like a flow sport like hockey.
I'll expand on that analogy. So many people are trading just like if they're trying to play hockey and they don't even know how to skate. And there lies one of the problems. They never learned how to skate and they're trying to play hockey, ice hockey. And they don't know what they don't know. It's not necessarily their fault. But if you're missing the basics, then the basics become really important. And so many people in this business are missing what's basic. And therefore, they can't build on anything if you're missing why price moves in the first place. So it's just like trying to play hockey, not realizing, hey, being a good skater is kind of important. And yet they're trading and they're risking their own capital. And then when they come to the conclusion where, well, I got to get my mind right, they buy all kinds of psychology books. Well, psychology books aren't going to help you if you don't know what you're doing. Okay. So yeah, psychology will help you if you already know what you're doing to get better, but it's not going to be, that's not what's the missing piece if you don't know what you're doing. All right. You don't want your surgeon, when you flatline on the table, to do breathing exercises and yoga. You want him to know what he's doing when you know what hits the fan. So most people can't default to any kind of basic level or baseline as to get themselves straight to reread the market. You're going to be wrong. You're going to take losers. Be good at, if you want to be good at something, be good at being wrong. I think that my successful marriage has everything to do with being wrong sooner rather than later, right? Because with my wife, I'm wrong a lot, but the ability to admit it is what gets me over the line. Same thing with trading. I take that skill from trading. It's okay to be wrong. It's not the end of the world. Now, if you're wrong a lot as a doctor, maybe, or as a lawyer, that could be catastrophic in that industry. In this industry, you're supposed to be wrong, but you don't want to be wrong for long, right? And you don't want to put too much emphasis on one trade, because usually when you do it, it's one of those blowout trades, right? Taking big losers, you're adding to losers, all these things that in a prop environment, you wouldn't even be able to do. And that's another problem that this business has, is everybody's their own boss, essentially. So you allow yourself to get away with things that you wouldn't. People say, well, you got good discipline. Say, I wasn't even disciplined. I wouldn't have been allowed to do those things in a prop community. So you have to create discipline by creating someone that's essentially your boss. It's yourself. The accountability is low because we all want to pat ourselves on the back, and it's tough for us to criticize your own trading. But when people do catastrophic things like add to losers or let losers get away because they just can't get out, I mean, that's just, you are just going to be cyclical. And if you're lucky, you'll be break even through a long period of time. That's if you're lucky. But yeah, you can't do things that you wouldn't be allowed to do in a professional day trading venue, which is a prop firm. And I want to say, every time I bring a prop firm, I want to make sure people understand. There isn't a ton of prop firms out there, and a lot of people online claim to be a prop firm or this or that. A real prop firm is someone that invests in the trader, and then there's some sort of profit split worked out, but they have skin in the game. If you don't make money, they don't make money. There isn't many of them around there. But that was and is the professional venue for day traders. I didn't even know what it was back in 2000 when I, eventually got hired by it. So I want to be clear, and I'm not advocating you got to go out and get hired by one at all. I'm just saying that that's how I started. First, I was on the floor. That was the professional venue of day traders before the screens. And then when the screens took over and we transitioned to electronic trading, it was prop firms. And generally, they're around the bigger financial cities, right? You're not going to find too many in Omaha, Nebraska. But it's, if you want to see a football game, professional football, you go to an NFL stadium, right? And a lot of people don't know where professional traders, day traders would be. And then they do internet searches. And one thing about the internet is it's great because you got all this information at your fingertips. And then it stinks because you got all this information at your fingertips. So you don't know what you don't know. You're inundated with a lot of information. Everybody sounds like they know what they're talking about. If they don't know why price moves and they can't explain it so you understand it like a third grader, move on, because that has to be what you understand to have that clickable epiphany type moment, why it moves. You want me to tell you my epiphany moment, Tom?
Yeah, I'd love it. Yeah,
When
I'd
I
love to
met
hear it.
when I met you. No. Um,
Waiting for that.
yeah. 4 weeks into my prop trading. Now, remember, I had taken some really good classes on how to pit trade. About 4 weeks, maybe 2 weeks into my prop trading, we had charts on one screen, and we had our workstation. We called them front ends. That was our dome. And so, anyways, I looked at a chart, and it was a chart of a price moving up. It was a rally, and I thought to myself, why would this price go up, but then stop going up and break? So why would I fade it? Because I was looking to sell it. But why would I sell it? What would make it work? What makes me better than others that are trying to sell it? And it hit me. It says, well, why is it going up in the first place? Well, it's because buyers are chasing it. And people are chasing it maybe to get out of a short, or they're buying it trying to open up a long. And at some point, you reach a capacity where everybody who wants to get long got long. So now they're sellers. And people who are short chasing it got out. So they're no longer buyers. And I said, that makes sense now. We created new sellers from the longs that opened up. So what makes me so special was that I could sell it and get others to come in after me at lower prices to sell it, because many of them were exiting a long position that no longer now is maybe in the money. And I have less competition as a short up here, because a lot of shorts from below had to chase it up and puked it, was the slang word from the floor, at those particular levels up high. So that's what makes you so special in a fading strategy, to not just pick highs or lows, but swing highs and things like that. You have to understand that. So that moment when I understood why it rallied and what would make me so special to sell it, and others would come in after me to sell it at a lower price, because that's what you need in this example for a profitable short trade to be profitable, right? And so if that's not understood, everything else you learn, try to put together, it's just like dominoes. You have to knock over that first domino for the rest to fall. So that's really important to get into that and understand the market moves based on other people's positions more than anything else. Buyers, sellers come from where? It comes from other people's positions, especially if it's an open position and they have to do something, right? When I want to get long, I'm flat right now, let's say. And if I want to get long, I don't have to necessarily get long. I might change my mind. I could pull it. So I might be a buyer, but I could always change my mind and not be a buyer. However, if I'm short with an open position and already short, then I have to buy it. You see the difference? I have to close this position at some point, and so do all other day traders. So you have to buy it now. And anytime you have to do something, it's more of an emotional decision. So what I ask people is, and you have to understand this and have to answer this quickly, is do you want to be short with a lot of other people? And most people would say, yeah. No, you don't, because all those shorts are buyers. And if you have too many buyers, does that help price go lower? No, too many buyers help price go higher. You don't want the competition. Understand open positions and what you turn into after you open a position. And now you put yourself in a position to understand and build out your idea. So you're flipping through a book, going through chapters of being able to create and react to changes in the market, transitional moments in the market. But you begin to build out an idea that's not random anymore. You're reacting to the market's psychology of where it's stuck on a whole. Forget about what you think. Start thinking about what the market's thinking. Start understanding when the market's too long, too short, if it's long, if it's short. And now your predictions will not feel like guesses. Instead of, they'll start feeling like probabilities, because now you're understanding why price moves in the first place. Most people don't understand that. And that's where you have to start and understand it. Everything else will be a little easier. Not easy, but easier. If you understand that to a point where you could explain it to someone. right? Why price moves and then what you're looking for to get there. And that's really important and missing.
So question for you, Anthony. You mentioned the uptrend. Let's go back to your your epiphany moment, right? Market's rising, and we know that buyers are becoming sellers. So the buyer pool is getting smaller. It might grow because people are interested, but as the price goes up, less and less people are buying because the price is higher, right? They're turning into sellers, right? So the seller supply is getting higher and the buyer supply is getting lower. When do you think, or when do you observe that, okay, now it's okay, me being not in a position to come in and short the market, fade the market? How do you observe that? Is it something based on the trend? Is it experience? Is there some sort of volume indicator, or if you see a lot of volume come in versus small volume, is there something you're looking at?
Not straight volume. We've created through MBO data that the CME releases and filter it, what's called OPP, other people's positions. So we're able to get into the intent of an order. So if an order is a buy order, there's things that we look at to have a sample size. That buy order was used to open a long position. That buy order originated as a buy stop. Because a buy stop is a buy market order when it gets triggered. But if it originates as a buy stop, then you could really accurately assume that that covered a short position for a loser. Anybody out there, when you're short, you're using a buy stop to get out, most likely that buy stop, if it gets triggered, is for a loser. So just think about how you put your orders in. And so now if you could get into a position where you know when stops come out after they come out, then if there are a bunch of buy stops that come out, then there's less shorts because most buy stops are used to cover short positions. And then, like I said, MBO is market by order. It's something the CME has been putting out for about 4 years. That raw data in and of itself isn't going to tell you anything. We've been able to look at it and determine where a buy order, the intent was to open up a long position. And then if I'm looking in your example to get short and I'm fading it, I like it to come into some area of resistance, and then I want to see a bunch of longs jump in. I want to see shorts get shook out, so there's less shorts, less competition for my short. And I want to see a bunch of longs pile in late. They're reaching. And a lot of people could relate to getting in late. So a market rallies, you buy it, and then it breaks. It's like, you know, they got bullish because price already was bullish. So they let price to predict price, or they use price to predict price. A lot of people see it go up, then they get bullish. No, you have to kind of be bullish, anticipating that pop, or else you're going to be reaching a lot and you're going to be late. So I want to see those guys come in late. I want to see them get long at the top, or what I anticipate to be the top. And that's what triggers me to open that short position. Less shorts, more longs. And so let me circle back to this. What is needed for price of anything to go down? Is it fair to say that more sellers and less buyers would help or make price go down? Would anybody argue with that? No, right? More sellers, less buyers. That would help the price of anything go down. That's why price goes down, right? More sellers, less buyers. Now, how do we anticipate their coming? Because after you see it, Tom, it starts to become too late. You have to anticipate what's coming. All right. How do you get to more sellers? Well, if you're long, you open up a long position, you're now a seller to exit that position, correct? So more longs, more sellers. So we got to the more sellers. How do we get less buyers? Well, if shorts puke, if shorts get shook out, then they cancel their buy orders below. So there's less buyers. That's the equation everybody has to understand like the back of your hand before you read any book, before you go into anything else. How do you get to more sellers, less buyers? Because without that, I had one guy say, yeah, that would be helpful for price to go down. I says, no, it's necessary for price to go down. It's not helpful. Say, oh, this would help. It has to exist or price won't go down. It'd just be a vacuum if it did. And you always have liquidity in most markets. So more sellers, less buyers. Here's another thing I want to add. A lot of people think that a lot of people are buying when the price goes up. No, they're trying to buy and they can't get filled. The house example. Someone's selling their house. 3 people want to bid on a house, right? Only one gets filled, but the other 2 were instrumental in the strength of the price of that house, correct? Only one
Right.
got filled. Not all 3 of them got filled, and they only got filled at a certain price, but they were important in the direction of price. So even though there's liquidity at each price going up, and there were people buying it, it's the ones who don't get filled that still want to buy it, need to buy it, that creates the definition of a rally. And so where do you get buyers that get anxious and say, damn, I can't buy it at 22, 22 half, 23, 24, can't get filled, 25. That's anxious, right? Where do you get anxious buyers? People who are stuck short. Well, why are they anxious? Because they're stuck short. They have to buy it. They're probably accumulating more losses. That's creating the emotion. So when you got too many people short, you're putting yourself in a position to say a lot of swear words as you're bidding it up. You didn't get filled at 24. All right, 26. Then you pull it when it comes back to 26. You would have got filled, but it goes to 24. You're like, oh, I got him. And it goes back to 27. Damn it, I should have just left it in. 6 bid, 8. Now it goes 7 bid, 8 bid, 29 bid. You bid 29s, you can't get it. You said, screw it, just go out at the market. 32 goes down to 26. That is what people in the market's going through. And when you go through that, it's not you personally. The whole market was caught up in that. You know what I mean? You're chasing it, comes to 26, you pull it, it would have filled you. No, and that's 27. Let me buy at 26. You don't get a chance. 29, down through 32. Screw it, 34. You get filled at 34, back down to 26. And now the wheels are really going, right? And now the emotions really go. Now you got to buy another book to how to keep your emotions in check. No, you got to buy a book on figuring out what you're doing so you're not chasing, or you minimize that chase. And that doesn't happen a lot. And I think a lot of people would connect to how I just ran that example through. It happens. If that happens to you a lot, you got to find better locations because you're stuck with the herd. You're stuck short with people that get stuck. And now you guys are all chasing each other, trying to get out. Right. And you're not buying it, but you're trying to buy it. Price doesn't go up when people buy it, but when they try to buy it and miss it, then there's enough of them to come back in. And that's really important. And that's going to not only start the understanding of how to predict price, but it's going to make the other things easier to understand as you go through it. But you have to understand that first principle, or else everything else is useless or just take you in a spider web of directions in this business or in any business, or rabbit holes. A lot of rabbit holes out there, and people tend to go down them. Sometimes it's their fault. Sometimes it's not their fault. You don't know what you don't know. I bought some bad education in the mid 90s or late 90s. It wasn't very expensive, but it was useless. But I tried it. You know, it was about some spread trading or something that was out there. So, but you don't know what you don't know, and now you got to find something that clicks for you and have that epiphany moment. I hope that makes sense.
Yeah, no, I think it all makes sense. And your analogy of the house is really easy to understand, right? Because you've got it's basic supply and demand, but it's also the concept of who doesn't get filled, who doesn't get the house, who doesn't get filled at the price they want. That's going to push it up if they need to be in the market. That's the key, I think, because when we're sitting on the sidelines and we're just waiting to get in, there's no have to. But when you're in the market, I think that's really important in understanding how much of the market has to get out versus how much are like you and I on the sidelines. And I say you and I, that's just situational. Could be different. Sometimes we have to be in the market. Seems like I do have a good idea of picking the tops when I'm going the wrong way, when I don't have to be in the market, right? I like that trend. That trend looks great. There's a target up here, and then the market turns around. Why? Because I'm not looking at who's in the market, who needs to get out, and where that pressure is coming from that turned it around.
Yeah, I mean, how many people take shots at trades that didn't fit their strategy or within their setup, and they're taking shots because they just missed a trade that would have been a winner, or they had a couple losers, they want to get the money back. And if you're taking, I call them buckets. If you're taking trades inside your bucket, great. And if they stink and you're not making money, at least you're doing what you're supposed to do. But how many people have trades outside that bucket where they just take shots and they're just mad and they're just adding, or they're just two losers, they got to get the money back? And if you were able to get half of those trades back, how different does your statement look? And the same with mistrades. Like, everybody has to have everybody does have a ready, aim, fire approach, whether they know it or not. That doesn't mean it's a good one. For example, ready means what gets you bullish or bearish. What creates your opinion? Just because you are bullish doesn't mean you're necessarily long, but you think the price is going to rally. Now, some people have really good rationale and things that get them bullish, and other people are bullish just because their last two trades were short and they lost. So now I'm buying this thing. It obviously can't go down because I was short twice and lost money. Well, that's not a great step one or ready approach, but it's a step one nonetheless. And then step two has to be generally location. If you're bullish, do you just buy it now, or do you wait for it to get into a location that is support and has those elements that stack a probability behind it? And then fire and the ready, aim, fire approach is a trigger. If I'm looking to get long, I want to see shorts get in and get stuck. I want to shake out other longs because I don't want competition.
You mentioned, you know, following mistakes with mistakes, or not understanding, and the tendency to change, or not, to change a plan, right? To try to chase profits, to try and rectify a bad trade. You could always say, what if you could take back one trade, what would it be? Just like in sports, you'd ask any pitcher, if you could take back one pitch in every game, could be the game-changing pitch. They know exactly what that pitch is. And you as a trader should know exactly which trade that is, what decision you made, because it should be, if not right away, but it should be impactful enough that, oh, that was a mistake. I should be able to identify one trade a day that didn't go right, that was the most wrong, or the most impactful, I should say. And that's something you should do as a good trader, reviewing your trades, say, what didn't I understand there?
Well, and the whole point of not being too perfect is someone's got a target at 33 even. You don't have to get out at 33 even for that kind of winner. Play in front of it. You don't have to be perfect. Play 32, and give yourself a cushion, because if it's a good target, other people are trying to sell it at 33. And if you're long from 22, there's no difference between a 9-point or a 10-point winner. Give yourself a cushion and be less perfect. To your baseball analogy, not just the pitchers that can get pitches back, but pitches that, everybody's going to make a mistake, and everybody's going to think it's their strategy to put on a trade, and it wasn't. That's different from throwing a pitch that is a low probability. I'm just going to take a shot. And there are pitchers that just made mistakes, and I shouldn't have thrown that. If you throw a pitch and you made a mistake with location, that's just in your skill. But if you're throwing a pitch where it should be a fastball low and away, and you're just going to be cute, throw a curveball, how many of those could you get back? Right? Because that's not a mistake in execution. That's a mistake in the whole psychology and the whole understanding the game and the hitter and the skill side of it. And so don't try to be too cute. Don't try to get perfect with your exits, and have areas with your entries. Don't get too perfect with those. If you want to get long at 22, wait a second. You're just going to put in a bid at 22 and hope the price stops there and fills you and then runs up to 32. It's not going to happen. You're going to be on the railroad tracks hoping the train stops, instead of being on the platform on the side where you could disqualify the trade or train as it runs by you. You don't have to get run over. But you want to create fire moments, which is qualifying and disqualifying the trade in order to, might be 22 halves, might be 21 halves. It's the area of 22. All right. Not that exact price, either get in or get out. And what happens with a lot of people, Tom, is they want to avoid reading the real time because it's hard. And it's harder when you don't understand what price and why price moves in the first place. But if you understand why price moves and it's back of your hand, now your ability to read the market becomes a little bit easier. And then you realize, wait a second, it's still not super easy, but it's easier. And I understand that I got to pick where the market says is the best price, not this holy grail 22 even. I don't care if you got the best support resistance levels in the world. You're not going to make a living just buying support and selling resistance at that exact price all the time, because you're going to miss a lot of times where the area worked and it was a winner, and you're going to almost catch every loser. So you want to get into not being perfect, but you're going to have to read real time. I don't care if you are a very short time frame trader and scalp, a swing trader, or even an investor. You still got to get in and out in real time. No matter your time frame, you still have to execute in real time. You're not going to get away from not having to read and create the skill to read the right now. Even if you're not going to be in for 5 minutes, you're going to be in for 5 hours. You still got to pick good locations. Good locations are really important. What's the definition of good location? A minimal amount of heat and price going your direction ASAP. And you don't need perfect location where it hits 22, fills you, and then blink your eyes and it's trading 24. That's not going to happen often. You're not looking for that. But you don't want to have a lot of time and chop around your entry because it's going to give you time to doubt the trade. You know what I mean? I'd rather be long from 24 and have it rally right away than long from 21, 3 points better, and have it play around at that price for 10 minutes. You know, the mathematicians would say, well, 21 is better than 24. Don't care. Give me where I don't have any chance to think. You want to react. By any chance to think, I don't mean, 5 seconds to think, but just minutes and minutes and minutes to outthink yourself. That's where a lot of people get in trouble.
Well, and Anthony, we talk about this on the bookend shows with the stops. We like to give ourselves, if there's a target area, and we call them areas as well, but it's, usually around a level that we know that we can see that we've identified, whether it's through trend lines or pivots or whatever it is. For a stop, we might give ourselves a couple extra ticks on the outside of it. And for a target, we might give us a couple extra ticks on the inside of it, meaning it's easier to get to. Like you said, it doesn't have to hit that exact number. It's an area. So do you want to get filled or do you want to be right? Sometimes I'd rather get filled if it means I can trade again, and not have to wait and wait and wait, which is what I think you're saying with the acceleration. You'd like to see acceleration, you'd like to be right, obviously, but that acceleration sure would be better. So you can do it again.
You know what I want? I want others to be wrong. That's what I'm looking for. I'm looking for where others are wrong and get on the backside of that, because that's what you need for a rally to happen. You need shorts to be wrong. So I'm waiting for the herd to be wrong. If I was in a helicopter, Tom, and I was flying over, I was looking at a herd of animals. When they got close to the cliff is when I'd want to get in. Not when they're just roaming around because they'll run you over. But when they're getting close to the cliff, all falling over is when good locations are good. So I need other people to be wrong. I don't worry about myself being right or wrong. I need the market to be wrong, or a group of people on the wrong side of the market be stuck short in a hole. And it's not so much acceleration, it's seeing open positions that are potentially on the wrong side, right? They're finally looking to get short after we broke 25 points and they're loading up short down there. All right. And then I see some longs that kind of puke. That's finally where the capitulation is that could create the bottom, and that's just stacking probabilities. So you're not going to have a winning trade, especially an effortless winning trade, unless you pick the moment where a bunch of other people got wrong. We kid in my room, in my community, we call them little Johnnies. And we joke that little Johnny is just an elementary kid whose parents, fund their account. I know you can't trade till you're 21, but it's just for example, and it shows that a fifth grader uses price to predict price. A fifth grader says, it rallied, let me get on. Or look at this support. It works so well. It worked 10 times in a row. I'm going to try it on the 11th time, because there's a lot of frame of thought from traders that you could attach back to someone who's in fifth grade. And here's why. When you're filled with emotion, when you have these two things called being right or wrong or making and losing money all come together, you're drunk with emotion. And so that's part of what you're watching. People do things that they never thought they were capable of doing. Discipline goes out the window, and they're very disciplined people outside of this. When you put those two emotions, overlap them, that's what you're trying to read. That's where you're trying to see these people get stuck to create good opportunity and location for you. And that's what's important with respect to understanding what makes a good location good. See other people being wrong and enough of them to create the buying that would come in after you open your long position, which makes a profitable trade profitable, less random, and it becomes less guesswork. If you feel like good guess, then there's no skill involved. It can't feel like you got lucky. Can't feel like it's a guess. You're a meteorologist. You say it's going to rain tomorrow and it rains and you didn't feel like you got lucky. You could be wrong, but you're not saying it's going to rain at 3:00 and it's 4:00 and saying, yeah, I still think it's going to rain an hour ago. A lot of traders do that. You have to be willing to admit that you're wrong. But from probability standpoint, the closer to right now, the easier it is to predict what the weather's going to be, right? It's harder to predict what's going to happen in 5 days, 5 hours. Same thing in trading. When you hear these people and you hear it at the beginning of the year, where is the Dow going to close at the end of the year? It's just a guess. And anybody puts any thought into that, I can't say it on this show, but it's just, if it's a game, fine. If they're right, they'll say, hey, I got that right. I must be smart. They're all just guessing. You can't possibly know what's going to happen in a week, 2 weeks, let alone 12 months. Because so many things can happen and will happen. All right. Meteorology is about predicting. The closer you are to the present, the more accurate you could be. And you're also going to be wrong. You just have to be willing to admit it. I see you playing around with the chart. You want to show me something on this chart?
No, I just have yeah, I mean, Jason, if we can show this interesting formation here, and I don't have the MBO data that you have on my chart. So this is the E-mini. It's a 10-minute chart. I don't have anything on it except volume, regular volume, but it's an interesting chart just because we have a relatively large bullish candle here, and it just makes me think that right here we just have a bunch of consolidation, a little bit of a rally here from a dip right around an hour ago, and all of a sudden you just see this big candle here. Right, this big bullish candle, and to me, it's what's happening here. If you could describe this candle and what we just talked about for the last half hour, how would you describe it without knowing what the MBO data is?
Well, you do me a favor, go to a 5-minute chart.
Sure, no problem. Yep.
All right, and so let me clarify with the MBO data because I don't want people going out getting MBO data thinking you can get what we have. That's just raw data. It'd have to be filtered in proprietary ways that we did it to be able to see when a buy order is in a long position where they're getting out. So don't assume, or I don't want listeners to assume that with MBO. You do need it because it does nice description of what orders are, but it's just raw data. You're not going to have what I have just from getting raw MBO data. Now, if you look at this chart, I had them go to a 5-minute. I always visualize congestion boxes. So I can't draw on this, but a congestion area, Tom's going to see it too. Draw like a rectangle. There you go. So right in there, and you're always going to have open longs and open shorts. All right. In the market at any time. Now you could consolidate and say in this consolidation box, you got people that are thinking it's going to go up. They're long, thinking it's going to go down. They're short. Then you have people thinking it's going to go up and they're going to get long or try to get long. And the same with the short side. So you have open positions and you have people who want to do something. And you have people on the sidelines that are just, going to wait. They're not looking for a breakout. So the anticipation of a breakout you have to understand what the dynamics involve. The anatomy of a breakout is you have people short in that box that Tom just drew, starting to chase it, saying the holy, what moment, right? And they don't want to be short if it slightly gets above the top of that box. So they put buy stops or they put their mental buy stops and they're trying to buy it. Then you also have momentum longs that say, I want to be long if it breaks out the top of this box after they see it. And some of those miss it and they become the buyers that chase it. So you have buyers of people who want to get long and they can't. And you have buyers of people who are short and they're trying to exit and they can't. And that's the anatomy of a breakout. You have to anticipate that and find when moments to, if you want to play a breakout, number one, understand that's the type of trade it is, a breakout trade. One thing I'll add is there's only 3 trades you're going to take. I don't care about time frame or how long you hold on to a trade. There's only really 3 trades you're going to take. A breakout trade, a fade, or you're going to go with the trend. Pretty much that's it. Yep. So this is a breakout trade. Understand that a breakout trade needs to work pretty quick after you get in it. That's an important criteria of a breakout trade. It's one of the hardest of the 3 because you're going to miss a lot of the winners and generally catch most of the losers. So it's a momentum trade. So you need momentum soon after you get in it. Or you could be early, could be late. Have to understand the dynamic of why it would move, which I just explained. And then what I would want to see if I'm bullish here, Tom, and I think that the high back at 1020, that swing high is going to get tested and maybe taken out. And at least that's the first target. I'm bullish because of that. I'm looking at 3 bars from the current one, somewhere in there, right? I'm looking in the middle. I'm thinking if we're going to take and we're going to go after the top of this box, I need to see a bunch of shorts somewhere in there before I take a shot. Now, we're able to see a bunch of shorts. You're not going to be able to see it through this, but a bunch of shorts is sellers that use that sell order to open up a short position, because I need more shorts to fulfill the dynamic of them then having to buy it to get out. That's if this particular consolidation had me bullish already, right? And had me anticipating a location to get long, and then the trigger of what we call OPP, other people's position, got me to fire. So if those things laid out, now if I'm just sitting back here and say, I'll take a shot, get long here in case it goes up, poor discipline. Even if it works, that's the worst thing. You don't want bad behavior to work. You don't just take shots. Something should need to get you bullish. Something should need to find the location to get you to aim and sit up in your chair, and then something should get you to fire. And if you don't have that, if you don't have those, then you're not going to have a process or a progression to go back and review, and you're going to create a lot of slop in your trading, and then you're going to have a nice day where you followed a progression, and all of a sudden you took a shot and gave back half your day. You're right. And that's where lack of discipline comes from. Could you go to you're on a 5-minute, go to a 2-minute real quick.
Sure.
And so you see how the consolidation is, from this 2-minute, how it's a little bit longer, and you could kind of identify the tops of it, the bottom of it. You have to understand how the market feels if it starts getting above it. And it goes back to what we talked about earlier in this conversation. What and why does price move? And so the breakout has everybody short in there starting to get anxious and try to buy it. And there's maybe more shorts than longs. And that's what's going to give the longs the victory, and the shorts are going to be the ones to chase it and push it to those higher prices that we had. I don't, especially if someone's newer into trading, I want them to be able to read and anticipate breakouts. Don't think that's going to be the first of the 3 that you're going to be great at. I want you to get faster by slowing the market down, and you only slow the market down by understanding why price moves. All right. It's not you getting faster. It's you understanding more, which slows it down. Think about football quarterbacks. They've said this, they're not the smartest guys in the world, but they understand the game, and it's slowed down than for you and I, Tom, to go out and say, how did he check down that receiver and audible out of that? Because they had 8 guys in the box and they were going to run. It's because of the repetition. They understand the game. They understand the routes. All right. You have to understand in its infancy why price moves. So then all this stuff is a reaction. Tom Brady isn't thinking too far, too deep when a 350-pound guy is chasing him. He's reacting in the pocket. And it seems like, wow, there's such great detail. There is, but only it seems like granular detail because we're not aware of what the detail is. When you listen to a coach a quarterback, and the footwork, and you want to have your shoulders back and level. So, there's a lot. It's not if you understand what the detail is, and then you work on it. And don't let that overwhelm you with trading. Because generally, I said something that clicked for a lot of people. I want to make what's basic to me basic to you, because the basic is what's missing in a lot of the education that's out there. And so you got to default. If you're missing the basic, you're going to have a heck of a time learning anything else. And the basics, what's missing. And almost 100% of the guys, Tom, when someone joins my group, I offer them like a 15, 20-minute call just to get to know them after they join. And just get a little background, tell them how and what videos are more important to watch on our host site, correct? So I always ask, why'd you join? And 100%, it's because you're different than anybody else I've seen online in not just how you explain it, but what you're explaining. This whole idea of why price moves. It's like I never really understood or could explain that, right? The intent of an order. People are talking about order flow and teaching order flow. That's all about the intent of an order and understanding why price moves. So it's too many longs, too many sellers, we're probably going to sell off. Crowded trade, if that helps. If it's a crowded trade and that trade's all longs, too many sellers, and the price of anything tends to go down when there's too many sellers.
Right.
But I hope that explained this breakout.
Yeah, I think that was a great explanation, and it was forming as we were talking. So I wanted to, kind of keep my eye on it. I'm glad you pulled it out. I do want to, we've gone over a little bit, so I do want to say thanks to Turtle. Turtle gave a nice comment in the chat. What the market is thinking, not what you were thinking, is what I learned the hard way. Thank you, Anthony, for your helpful insights. That's from our regular viewer, Turtle. And then David Dominguez, another person that comes to our bookend shows. I need work on accepting loss. I tend to do great for days or weeks, and one day will blow me out. Any suggestions? I was trying to find a software for NinjaTrader that will lock me out to try and save me from myself. I think he's being a little tongue-in-cheek there.
Well, the thing is no, don't find that. You got to do it yourself. Are you adding the losers? Because that's the problem. Are you taking shots that's outside your strategy? Because then that's your problem. And set stops that are tighter than the big losses you're having. But don't have a crutch. You gotta be an adult. You got to get out of your trades. Don't let anything shut you down. You have someone help you. Hey, let's get out. But if you can't understand and have that discipline, then they don't even have that exist where it shuts you out. You want to say, I did it. I got up 5 days during the week and went to the gym, right? I worked out, or I stuck to this or that. You'll build momentum, and then you'll build size. You'll never build your size if you're having 5 winning days and 1 losing day, and it gives back all 5 losing or all 5 of the winning days. So you're going to have to create the discipline by doing it yourself. Don't add to losers. Don't take trades outside your strategy. And whatever your big losses are, you got to minimize those by just putting hard stops in to start. And then there's a lot of other things that could help you, but it's a general question. Hopefully one of those answers will help you.
Anthony, thanks so much. Where can people find you if they want to continue the discussion and learn more?
The best is to go to my YouTube channel, search Edge Trading Group. If someone, I don't know if you could pop that in, or someone could pop that in, Edge Trading Group on YouTube, and you're going to see a bunch of videos. My website's edgetradinggroup.com, but the YouTube channel, go there first, because I've got 5-minute, 3-minute clips of highlights from every day that we go through, right? And so one other thing on this chart, Tom, you still got this chart up?
I do.
Where the stop started, which means where we break out, we often use that as support. So why? Because where we break out, you had a lot of shorts trying to get out at that moment. So they're all hanging down there with their bids, praying to get out if it comes back to where it got fast. So that's why you often see it curl and hold it as support. If it breaks down through in that box, through the middle of it, becomes a head fake, and they're going to take out the bottom. These are really good breakout dynamics that will help you anticipate, therefore predict when a breakout already happened, and then anticipating it in before it happens, because that's where money's made. But if you don't understand what it takes to make it happen and everything else, you're never going to put yourself in a position to predict it and anticipate it. But know the dynamics that makes price move and other people's positions. So edgetradinggroup.com, and then search that on my YouTube, or on YouTube. You find the channel and watch some videos, and then you'll see where you could go to the site from there, Tom. But pleasure talking to you again.
Yeah, Anthony, thanks for coming on. It's always a pleasure to talk to you. And, I find it so, rich with information. So I hope you get some of the viewers take a look at your site and learn more. It's certainly, seeing it in action or seeing it happen as we speak, always a good thing as well. But again, thanks again, and Happy New Year, and hope you have a great 2023. And till the next time we're on, it'll be great to see you again.
Yep, you too. Happy New Year, Tom.
Thanks. And thanks to everybody for coming. A reminder that Jim will be back. Jim Cagnita, that is, will be back for bars closing at 3:15. In the meantime, have a great trading day. We'll see you next week.